Hi, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for March 19th of 2023. Please see our disclaimer for important information. I think we're going to start this week where we did last week, and that is the failure of Silicon Valley Bank. Its fallout. Much has been written over the last week, and much has been speculated over the last week in terms of where we go from here, what's this potential contagion to other banks and things like that, and how it bleeds into a more kind of general anxiety with regard to the future of interest rates and whatnot. So we've got a lot of slides on that. And I found this from Visual Capitalist, which I just love for people that are a little bit more visual than data oriented. And so obviously Silicon Valley, as we now know, is the second largest bank failure behind Washington Mutual, which eventually was sold to JP Morgan back during the global financial crisis, but it failed and it was 188 billion, Silicon Valley at 175 billion. And so last week, as we know, the Fed invoked its systemic risk exception and shored up and guaranteed all of the depositors in conjunction with the FDIC and the Treasury Department. So all of the depositors for Silicon Valley were made whole. They also instituted a bank term funding program, BTFP, and that is designed to allow for eligible securities to borrow against those dollar for dollar at par, which is very important because a lot of the problem of Silicon Valley was that they had a surge in deposits at the trough of interest rates when interest rates were at their lowest, and so they bought a lot of longer dated maturity mortgage-backed securities and treasury bonds. And then, of course, when interest rates went up, the carrying value of those securities went down, and so it's important to know that in this bank term funding program that the Fed is allowing people to borrow against the par value of their securities, even though on their books they may be carrying them at a loss. And so, a lot of this is born out of the fact that rates increased so much, and banks that were not nimble, like Silicon Valley, that, again, you can argue very strenuously that it was management oversight and portfolio oversight that led to this conundrum. At the same time for Silicon Valley, its deposits were drying up because of the nature of its clientele, and also in conjunction with interest rates moving higher and the value of their securities portfolio going down, that it created this perfect storm, which the Fed, I think, in hindsight, probably realizes that it's not a regulatory problem, it's a supervisory problem. And so we are hearing much more about tightening up supervision, tightening up analysis of bank balance sheets, maybe doing another stress test that we remember so well having occurred multiple times in the early part of the last decade following the global financial crisis. But one thing before we leave this slide I wanted to point you attention to is those bars in the middle. It says a wave of bank casualties followed the global financial crisis. And we all know that the global financial crisis was really 2008 and then the beginning of 2009. Then confidence began to kind of firm up. Stock markets bottomed on March 9th of 2009 and started their upward ascent. But as you can very well see here, that the wave of bank casualties continued on for several years after that, as we weeded out some of the weaker players, folks that had weaker internal controls, internal portfolio management, and so on and so forth. And so, again, I think, there is some anxiety out there about this contagion factor, and are we going to see more of these types of things? And honestly, I think we probably will. Interest rates moved up so fast, and it's nothing that was on our radar literally a month ago that suddenly come to the fore. And I think with some degree of reasonability may help to tighten credit further, which is actually what the Fed wants to see. They want credit to be tight, and so the economy to slow down which will then take care of our inflation problem. And I do think that all of these things are in motion already. I think maybe what Silicon Valley did was probably in the psychology of the market, kind of accelerate that a little bit. Now, proof will be in the pudding. We'll have to see, but again, that's kind of where we are. But we're gonna look at some slides here that talks about relative health of the banking sector and the importance of these small and medium-sized banks. And then we're going to get into talk about some economic variables that we're seeing right now. So as we're looking here, I wanted to talk a little bit about the health of the banking sector. And so this came from a JP Morgan research piece, and I think it tells a story that we want to tell. And that the tier one capital ratios, these are capital that's being held on the books against the potential for loan loss. These are not loan loss reserves per se, but it's just capital to be held on the balance sheet. And this is a tier one capital as a percent of risk-weighted assets. And so obviously you want that number to be high. And after the global financial crisis, there were some controls and minimum levels put in for various tiered banks. And as you can see that after 2009, when this tier one capital ratio troughed, that we've been at a very high level. And this data series goes back to 1991. So it does tell us a lot. Banks are in good shape from capital. Now, if you look at loan to deposit, which is on the right, obviously if you have lower loans relative to your deposits, that's a sign of relative strength. You're not overextended from a lending standpoint. And you can see very clearly from a time series that goes back all the way to 1973 where we are in that regard. And so even though that is moving up, as you can see that little tail hook at the end, you can clearly see that we're in good shape relative to historical trend lines. All right, now we want to look at something from BCA research. Shows us the importance of small and medium-sized banks, and this is a really interesting analysis here. So if you read it from left to right, that banks with less than 250 billion in assets, and again, I would characterize that as like right in the heart of like call it a regional or super regional type bank, but obviously nothing like a JP Morgan, Wells Fargo, somebody like that. But you can see here they account for about half of commercial industrial loans, C&I loans. They account for a little less than half of consumer loans, but they account for a vast disproportionate share of commercial real estate loans and residential real estate loans. So very important in the ecosystem here. So, as we talk about, some of the other banks that are, maybe the subject of some innovative type financing arrangements with the regulators, I think that's why, because they're so important as a part of that ecosystem with real estate. Well, kind of switching gears, but also related here. I talk a lot with clients about idle cash balances and emergency funds and things like that. The good news here is that obviously with rates moving higher, that crediting rates are moving up. They're moving higher. However, you can see at the top end of this chart that deposit rates at commercial banks have barely moved up. And you see that in the amber line, that's Fed funds, that's short-term interest rates. You can see the disparity now where, banks are really reluctant to raise their rates because it's a cost of funds. So they've been very reluctant to raise their rates. So all of you out there with cash sitting in your commercial or individual checking accounts, check with your bank because crediting rates are still very, very, very low. However, and we've done a lot of this internally, is move idle cash into money market mutual funds or CD alternatives, not CDs, but CD alternatives. And those rates have very much kept up. And you can see that very clearly in the bottom half of this chart. Well, with all of the news out there with regard to Silicon Valley, the banking sector, et cetera, we've seen a fairly stark repricing in the expectations for future interest rates and Fed rate hike expectations in particular. So as we see in this chart, back at the beginning of March, or I should say maybe the 8th of March is in that amber line, you can clearly see that the terminal rate or the peak rate in Fed funds, i.e. short-term interest rates, was getting close to 6%. And in 1 week, that changed dramatically. And you can see here very clearly that that the market now believes that we're a lot closer to peak rates. It may not even reach 5%, depending on what the Fed does here coming up in their next meeting very, very shortly. That they may pause, although there's still a pretty decent probability that they're going to raise rates by 25 basis points or 1/4%. But you can see here that if that happens, then that's pretty much, at least right now, the expectation that that's going to be it. And then the next move is likely going to be down, kind of pursuant to maybe an economic slowdown here. So again, as far as that curve coming back down, we'll have to wait and see. It will definitely be data driven. But I think this whole rhetoric around the banking sector, maybe credit standards tightening up a little bit, financial conditions maybe worsening just ever so slightly, that could drive us a little bit closer to this recessionary environment that I think we've been anticipating. Well, and just talking about that Fed implied or that market implied Fed terminal rate, where do rates stop? And just this is another iteration of what I just showed you in that last chart, that we were pushing 5.7, 5.8%, and now that's down below 5%. You can see in literally 1 week how that changed dramatically, and we've seen a lot of changes and a lot of things over the last week. This is just one of the many things. So terminal rates now expected to be we're expected to be very close to that terminal rate with where rates are right now. All right, well, here we go with market pricing for the Fed funds rate change in the second half of the year. And that too has changed in fairly rapid, dramatic fashion. You can see here that we have been expecting the Fed to actually decrease rates. This is the market pricing. This isn't the Fed voting members or the Board of Governors or the Open Market Committee saying this, because they've been fairly limited in their guidance as far as that goes on when they might actually decrease rates again. But the market clearly has kind of factored that in, and they have for a while. And you can see here that now that the market is expecting about 0.6% rate decrease in the second half. Well, so much for quantitative tightening. We're back in a QE mode, quantitative easing mode, and that happened fairly dramatically. And these next two charts really illustrate that. So this is the discount window at the Fed where banks can borrow, and so this is an indication of that interest in that liquidity that is provided by the Fed, by banks. And you can see over the last week that has dramatically spiked. You can see back in the global financial crisis where we are over the last week, just puts that, makes that kind of somewhat pale in comparison. And you can see also back in the pandemic where that liquidity discount window was taken advantage of. But last week was a pretty profound move in this regard. Now we look at the Fed's balance sheet, and we've been praising how that's been coming down consistently ever since the beginning of last year. It continued to rise until May-ish, and then that's when we knew the Fed was going to begin to allow these securities on their balance sheet to kind of run off. They would mature and they wouldn't be replaced, and so the Fed's balance sheet would contract. And this is a way that the Fed is taking liquidity out of the banking system. Well, guess what? Last week, with this bank term funding program and the increase in activity at the discount window, that in 1 week we have unwound all of the balance sheet reductions over really the last 6 months almost. Here's a look at global monetary policy. This is from Fidelity and Urian Timmer. He does great work, super analyst. We can see that, this is the basically the MSCI All Country World Index in the black here. This is basically a stock index, global stock index, which does include the U.S. And then you can see here in these light colored bars here is a quantitative easing of all of these major central banks. And you can see here where, everybody peaked about the same time. Some actually, I should take that back because the Fed was actually somewhat late to the party. And, there are other central banks that were tightening well before the Fed was. But then you can see that has kind of reversed a little bit as of late, or kind of plateaued. And the relationship here is really interesting, that you can see that as quantitative easing, again, injecting liquidity into the market, you can really see pretty poignantly here how that has fueled global stocks in general. Well, we haven't shown this in a little while, but I wanted to show you high frequency data, courtesy of our friends at First Trust. And we've actually established in air travel a new post-pandemic high over the last week, ironically enough, with all the stuff that's going on in the news, that TSA checkpoint data is at a new post-pandemic high. We knew it would take a while for air travel to kind of recover, especially on the commercial side. I'm not saying that we're quite there yet, but we're only about 1.5% below where we were in February of 2020. Global commercial flights, we're seeing more inventory being put on the market. And then the other thing I wanted to focus your attention on is that month over month change, that with the slowing in the economy, we still see retail sales. We still see consumption. You look at hotel occupancy at almost 12%, open table restaurant reservations up 16% over the last month. And then some of the more industrial measures, we see steel production up, although rail car traffic is down. And then, we still see that tightness in the labor market. So, there's puts and takes. There have been for quite some time. And that's why the Fed's job is made a lot harder, because the economy is frankly fairly resilient. Consumers have a lot of standby liquidity. We see balances and checking deposits still relatively high. And for the most part, we see businesses with fairly strong balance sheets overall. Well, so to the notion of slowing down, we have this, and this is the leading economic indicator index. This is published by the Conference Board, and you've got several different measures here. So you've got in the blue, that represents a year-over-year change in the LEI, and we can see that is clearly moving down. And what this chart is trying to tell us in those shaded bars is that when it reaches this level and this negative rate of change, which is about 6% on a year-over-year basis, that is very consistent with a recessionary period. And going back to 2001 and the tech bubble and the global financial crisis in 08 and into 09, you can see that the LEI actually dipped down greater than that, and then with the shutdown of the pandemic as well, dipped down a little bit more than where this red line is, which it represents where we are now. And then overlaid, you see the change in year-over-year real GDP. And there is I'd say that there's a reasonable correlation here. Obviously, the LEI and its changes are much more amplified than the changes in real economic growth. But the idea here is that we're trending lower on the LEI, which is by its own definition and construction, a leading indicator. And so that is moving down, so we would certainly expect real GDP to follow. Bloomberg Financial Conditions Index represents a very tight condition now, even though that has eased up a little bit in the last week. We see a trough on March 13th, and then March 14th. Here we have uh, a little bit of an easing, but it still represents a tight condition here. Housing affordability is a little bit improved. We can see this chart with a little hook at the end, but you can see that we've had gradually decreasing affordability with interest rates moving up. Although with the Silicon Valley episode, we have seen rates come down, actually very dramatically. I mean, we haven't seen some of these rate movements in decades that we have seen over the last week, and they've gone down, and so that is helping mortgage rates, which in turn is helping builder sentiment and helping to drive a little bit more interest in the housing sector right now. Well, here's an overlay of housing starts as well as building permits. And so the building permits is in the amber line, the housing starts are in the blue line. And you can see, this in a time series, it goes back to 2004, obviously where the global financial crisis impacted that. And so therein began this long decade of under construction, which has kind of led us to where we were last year, and that we had an increase in demand, but a limitation in supply, which then accordingly drove home prices up in a very dramatic fashion. Well, okay, so that has unwound a little bit. So we see starts and permits both trail off during calendar 2022, but we see them pulling back up. In fact, in a single month, in a single month for the January reading, we saw almost a 10% increase in starts, which is a pretty stark 1 month change. But you can see here, overall trend is still moving higher, although obviously we had a very strong kind of year of reckoning last year. Well, here's core consumer price inflation as well as overall consumer price inflation. The headline CPI here is in the blue line. And just to highlight, we've shown you this chart in several iterations here recently just to kind of keep tabs on this. So inflation going down, but as we'll see in a second, not all of the areas of inflation are coming down at the same rate. I've used this analogy like 4 times over the last week. When you want to affect change in inflation through a contraction in the money supply or by raising short-term interest rates, both of which are at play now, then this doesn't happen overnight. And so the analogy I use is like when you go on vacation for a couple weeks, you turn your thermostat off because you want to save electricity. You come back and it's 80 degrees in your house and you want to cool it back down to 68. Well, it doesn't happen at the snap of a finger. It goes from 80 to 79 to 78, and sometimes it can seem like it's taking forever to get back to where you want it. And that's very similar to what we have here with inflation. And it is coming down, but less pronounced than some had expected. But I think looking at it objectively, this is clearly going to take a while given the strength of balance sheets in the corporate sector, the strength of deposits within the consumer sector, which is still continuing to fuel retail sales and consumption. But you do see both of those coming down in the aggregate right now. Here's a look at shelter as a component of the CPI. And in fact, it's really more than a third of the core CPI. So it's very important from an index standpoint. And shelter costs are actually pretty high right now. We were kind of looking at this last year when home prices were moving up. And again, shelter is kind of a more broadly defined term. But when you look at home prices that were moving higher last year, well, that obviously stalled and reversed. At some point, you see rents coming down, but it's a more nuanced conversation than that when you talk about shelter, because you've got first-time home buyers that are still largely priced out of the market, and so they're still renting, or they're living with parents, so on and so forth. And shelter costs just in the aggregate are still pretty high. So this is continuing to fuel the inflationary bug, even as we see other elements begin to trail off in inflation. And here's service within the inflation measurements. Look at core services at the CPI level, and this is what we're looking at here from our friends at FS Investments. You can still see that that's pretty high, even though it has come off its peak. And so, what does this represent? What are core services? Well, it's another way of looking at this, at the whole shelter issue. So we've got rent, owner's equivalent rent. Then we have health insurance, which are kind of a broader basket of items just outside, well, I gotta say a basket of items that include shelter components, but it also includes other things. And we see that that's just still sticky here in levels that are above the longer term trends. Well, to kind of leave you with a good feeling on inflation, and recognizing that there are elements of inflation that are sticky. We know that that might continue to be sticky for a little while, but should come down. And but as we look at this slide and you back out the OER, the owner's equivalent rent, you back out the shelter components of core CPI. And again, OER is a significant part of that. So when we back that out, you can see a more deliberate decrease in the core CPI. And so, the takeaway here is that when owner's equivalent rent, shelter costs, and those things start to come down a little bit more in a more pronounced way, then you're going to likely see some acceleration in the decrease of overall inflation, and particularly in core inflation, which I think all of the pundits and certainly the Fed are more concerned about. Even though the Fed doesn't look at CPI, they look at personal consumption expenditures. But it's all relative. It's all really kind of the same rough proxy, even though the CPI and the PCE are calculated differently. But clearly here we see that inflation is coming down. This should give us comfort. Maybe it's not coming down as fast as some would expect, but it is coming down. And here we see a little tidbit from the labor market. You see in the kind of this aqua blue line here, the trends and the challenger job cut announcements. And those have clearly picked up here in the first quarter of this year. You can see that very succinctly. And then also you've got jobless claims, a 3-month average of that. And we know that jobless claims have been very low, but if the Challenger survey is a fairly decent predictor, and again, those announcements are on a 3-year moving average as well, that we should see jobless claims continue to pick up here. A quick check-in on crude oil. This is something that when you kind of like translate this into distillates, one of important distillate of crude oil is, of course, gasoline, kerosene, diesel, et cetera, et cetera, et cetera. Machine oil, you name it. But gasoline is very important to the consumer psyche. It's one of the most observable pockets of inflation outside of food that you can see, with the very naked eye if you're the average citizen. And so crude oil prices have come down, feeling that economic slowdown will reduce to some degree the demand for oil on a daily basis, and that may very well be true. And we also see some supply issues, and there's some other political plays at work here, but you do see crude oil prices meandering and then maybe even ticking down a little bit. Here's a quick look at the PPI, the Producer Price Index, and a 1-month change. We got a negative print here, and this was better than expected. So with all of the speculation on the consumer price side, we do see that producer prices are beginning to come down. Now let's transition into the investment world from the economic world. And here is one of my favorite charts. And this is from Fidelity. And it plots compound annual growth rates uh, from January 1st of 1995 through the end of February a year ago. And this is actually one of my favorite slides. And so, again, it shows you if you had put money to work at the beginning of 1995 and you were fully invested for the whole time, your rate of return in the stock market would be about 8.7%. But time and time again, when we get into volatile periods and kind of this behavioral impulse kind of takes over, and it causes some people to say, listen, I want to be out of the market. Well, it's so hard to time this stuff that, and people are very reluctant to get back in. And usually, that behavioral impulse keeps them out and they wind up missing a lot of the return. And so this chart, again, one of my very favorite charts, is if you miss if you miss the 5 best days in the market, your return over this relatively long period of time goes from 8.7 to 6.8. That's an annualized return. So you're giving up, essentially 2 percentage points if you miss just the 5 best days in the market. And then similarly, if you miss the 10 best days in the market, then that return from that 8.7 goes down to 5.6. And then again, if you are out of the market, and typically you have a lot of really, really good days in the market when the cycle ends, when that downturn ends and the market begins to anticipate that new economic cycle and it begins to accelerate, like 2009, same deal. And also to some degree, circumstances were different in 2020. After the economy began to reopen, a lot of technology stocks took off. But needless to say that stocks tend to have really good days when they're beginning a new market cycle. And so if you think about this, if you missed we'll just call it the 40 best days in the market, that 8.7% annualized return goes to basically nothing, just very slightly positive. And so that's why it's important to stay diversified and stay invested. And this chart here really helps to emphasize the point that I was making in the last chart. And I actually like this one too, because it shows you, from a kind of a sector return standpoint, what to expect. If you're in a recession, obviously, you're going to have negative returns on equities. That's very time tested, and it's well expected too. So you're in a recession, stocks earnings go down, revenue goes down, and stock performance is weak. But if you go once you transition into an early stage of a new cycle, then you see equities perform very, very well. And like I said in the last slide, sometimes you have some outstanding returns at the beginning of a new market cycle. And you see mid-cycle, late cycle, a little bit more tepid, but then other areas tend to take over, like commodities are more late cycle. And investment grade bonds tend to do well in a recession, although we all know that with rapid rise in interest rates that didn't happen last year. But in an early cycle, again, as you look forward to next year, to 2024, you're going to have more than likely, assuming there's something that doesn't happen in our world that we can't anticipate right now, that if you are in an early stage cycle, part of the cycle, then you should expect all of the components to work well. Commodities slightly positive, fixed income slightly positive, but then equities perform well. Here's a quick look at value versus growth. And so, a lot has been made this year thus far that growth has outperformed value. But value outperformed growth last year. And what are the components of the market that tend to do well when you're on the precipice or in recession? And you see here from a valuation standpoint that value is still very cheap relative to growth. That growth itself is relatively expensive. And so, when you look at this chart, what it tells you is that, where you should be is kind of, capital strength, strong companies, strong balance sheet, strong cash flow. Cash flow tends to translate into higher dividend yields and dividend paying stocks and dividend growth stocks. or dividend growing stocks, I should say, uh, and then certain sectors of the market that tend to be a little bit more resilient and just more sturdy cash flow companies, like say in the healthcare sector and in the consumer staples sector, and so that's really the part of the market that has the most favorable investment characteristics right now. Here we have a chart of, in the red dots, those represent intra year drops within the index, within the S&P 500 index. And you can see that there are a lot of years where you have an intra-year drop that is meaningful. And but then you can look at these solid gray bars, and you can see where the market ended up for those years. And so despite like an average, this is from JP Morgan, an intra-year drop of like say 14.3. Overall, again, going back to 1980, you can see these red dots, very, very illustrative here, that despite that intra-year drops of like 14%, the annual returns were positive in 32 of 43 years, which is what we'd expect overall, that the market is generally up a lot more than it's down. And even though we had a decline of 19% as it ended up last year, that you see that overall that years that exhibit these drawdowns tend to end the year up more often than not. Quick look at our Treasury yield. You can see the 2-year Treasury yield, which had been meandering up, a feeling that these short-term rates were going to have to go higher to combat inflation. This is after our consumer price index print that we got a couple weeks ago. That quickly reversed in Silicon Valley, and you can see the last 5 trading days in a chart from Charlie Bolello that we had over a percentage point drop in the 2-year. And just to understand the volatility in the fixed income market, I mean, this is a tremendous change. This is the largest 5-day decline in yields that we've seen since 1987, if you can imagine that. And as a result of the drop in the 2-year yield, we can see the change in the yield curve. So it was very recently that we had the most inverted yield curve since September of 1981. And I think at that point, obviously we're dealing with much, much higher rates, and we were dealing with a pretty severe recession that was exacerbated by interest rate increases that were very pronounced in an attempt to combat very high inflation back then. But here with Silicon Valley, we've had an increase in the spread here of about 65 basis points, or about 6 to 7/10%, and that's a pretty dramatic rate or spread increase itself. Here's inflows into cash. We've had, particularly over the last week or so, we've had this dramatic rush back into cash. And we've been talking for a while that a lot of money managers, despite the higher rates, were underweighted in cash. Well, here we are entering the 3rd week of March here, and we can see that those cash balances are really moving higher. And so again, the caveat is that when you're holding cash, it's really good to look at those money market mutual funds, because the crediting rates on just idle cash are not that great. And we'll end this slide pack on something that kind of caught my eye in some research. Internet crime losses. As we kind of look at Boyce and Associates, we have a new IT vendor, and we're really spending a lot of time with our cybersecurity, looking at the strengthening those policies. That it's really dramatic that we've got over $10 billion of losses from internet scams, and so urge all of you to be vigilant, and just as we are internally with our own systems, looking at anti-phishing measures, better software to help screen emails to try to prevent that type of fraud. But anyway, it's a dramatic rise over the last several years. for the chart pack today. Hope you've enjoyed it. Have a great week. We'll talk to you again soon. Take care. Bye.